Welcome back, traders and investors. We have Nic Chahine creating income with option spreads. Nic, you have been all over this market here. What is your crystal ball saying today?
Well, the crystal ball, we were talking about that offline a little bit while we were waiting for you to come back. We were talking about the overall market. The last couple of weeks, we've been able to short it at around the 1900, 1895 level. This week, I've been preaching since the end of last week that they've tried so much. They, as in the bulls, have tried so many times to break through. They may have some pent up pressure there that might push them and overshoot a little bit. So the short at 1900 obviously is not so easy this week, but it's still a shortable pop in my opinion, because where is the catalyst to take us further? We need good news, and this morning it looks like we missed on the retail sales just a few minutes ago, and it's all back to dropping markets, rising TLT, dropping TNX, which is the yield on the 10-year, and also rising yen. We were talking offline a little bit in the overshoot yesterday, although it was a great day across the market. But I think that there was some short covering and some overzealousness that I don't think was worthy. Two things. One thing mainly scares me. I'm not one to say that the VIX is a good sign of this or that, but if you look at the VIX's 1 year, Dennis, you were asking me what we want to look at today. Look at the VIX. Every time it goes down to this extreme low, it spikes within days after that. So having the VIX so low, I'm not saying that the VIX is still a good sign of nervousness, but it's a good sign of things to come, I think, still. Because it hasn't broken down completely from the lows, the extreme lows that it's hit, but it's so consistent. Every time it hits so low, within days there's a spike coming. So that worries me a little bit. Also, Ukraine is getting messier and messier, and we're not paying attention to that enough, I think, we as in the market.
So there's still some concerns overall here for you then, Nic, that you're still looking here as this might be a rally where it may not follow through?
Right. My plan last Friday, I did a video and posted on Benzinga, I want to take advantage of the run and the dip. So I wanted to time it this week to buy some put spreads and finance them by selling some credit put spreads lower. So if I was thinking that they were going to test the 1850, say on the SPX, I wanted to buy somewhere around a 65. So I would buy an 1865 put, sell an 1860 put. So that puts me in a bearish position, and I would finance it by selling lower than that, say at the 1825 or 30, wherever I can get premium, and do the opposite. So sell the higher leg and buy the lower leg. So I would finance the higher put spread, the bearish position, with a bullish position. But I would also short the pop. So if we break 1900, say shoot to a 1905 or so, I would be brave enough to sell the 1920s maybe and buy the 1925 calls. So I'm shorting the market at that level. So I end up with an iron condor for the week. Now, that is a tricky maneuver for somebody who's not very nimble. You can do the same thing if you go out in time. I'll give you an exact example. In Google, I did a portfolio spread in June. So I gave myself some time and I gave myself some room. What do I mean by room? I sold the 470 put and bought the 465 put. So what is that, 8% lower than what it was yesterday? And I collected the premium. I did that on Friday, and Monday after the pop, I closed it, and I made $280 on 20 contracts. So I didn't risk a lot, I didn't sweat a lot, and I made some money in 2 days. That's an average investor, if they have enough margin and know-how, they can do this without sweating much. Another example is a couple weeks ago, I sold an NDX, that's the NASDAQ, a June credit call spread when we were all happy on one day. I said, this happened, it's not going to last. So I sold out in June a credit call spread at the 38.25. Mind you, it's a $25 wide spread, but 38.25, that's way higher than we were at the time. And it was a $2 spread, and I booked it for like 50 cents or something after the NASDAQ broke down. So that made a mortgage payment with just 10 contracts. So
And
there are plays that you do.
I mean, you're talking about really something, really nothing to take us higher, but what's out there to really take us lower? I mean, you do have the Ukraine thing going out there that just but when the news comes out on that, it really doesn't seem to affect the market that much.
This time around, but we did have a couple of dizzies before. I'm not one. Every time, if you and I have talked before offline, and I don't see doom. For doom to happen, like people saying we're going to drop 10, 15%, for real doom to happen, we need another shoe to drop. The current shoes that we have, the current variables that I see, are not enough for us to drop. Yes, it's not rosy, but it's not terrible. We're still growing at the same lousy rate we have been. Europe is recovering. Everything is clunking along. There's no doom. But should we have a disaster in China, that's a new shoe. That might take us lower. But I'm not forecasting doom. But I'm also saying we're not going to be, hundreds of points higher from here at the end of the year, because we need another catalyst. Just like we need one on the negative side, we need one on the positive side to take us much higher than this. So meander is the trade, I think, for the rest of the year. That's why I keep doing these iron condors. It's perfect for this environment.
Yeah, the last 2 months we've been hanging out between this whole 1850, 1860 and up to 1885, 1890. We're trying to break out of here. Like when you look at the chart on the E-mini there, it looks like this is a classic breakout. It looks juicy. And that is the thing that is concerning to me as well. Whenever they look really juicy, they usually aren't as clean as you think they're going to be.
My God, you just took the words out of me. Look up, whenever you get time today, I wrote an article on Benzinga last Friday, I think, or Thursday. I said, you see doom, I see breakout. When everybody was not happy about the SPX, and I think it was from Wednesday night I wrote the article, well, Thursday night. One day we were not doing well. I said, you see doom, I see breakout. I think that was the headline of my article. And that's exactly my point. If you look at the SPX or the SPY, it's threatening a breakout, because everybody was talking about the TLT threatening a breakout. They both look almost identical in the last 3 months. So they're both knocking on roofs from higher lows, which usually end up in the resolution of saying the bears saying, I'm tired of selling this level, and the bears poke through and run. So the same argument that works for the TLT, that if TLT is going to run, and by the way, if the TLT runs, the markets are falling. It's an inverse relationship these days. So if the TLT breaks out, then the markets break down. But the SPY is threatening to break out. So it's, some people see doom, other people see breakout. And that's the argument. But I'm saying neither is right. If we break out, we're going to retrace. And I don't think the TLT is going to break out too badly.
The fade trade, it's still working. We've been talking about the fade trade for the last couple of weeks, and I think that's still the play. I think fading all of these moves has just been paying your bills here for the last 2 months, and I think it continues to work. And it's gonna be scary if we start pronouncing by the end of summer, and everybody just coming on with their party hats on, and you know how I am. I like to read the herd, I like to read the sentiment, and I like to go the other way. So that's what I'm looking here, is obviously just get a feel for where everybody is and go the other way. The fade trade.
The fade trade. Well, the herd is saying that the open interest in 1850 is not is the high point. And one thing yesterday I said in the pre-open letter, I said that the IWM, the small caps, which had a fantastic day yesterday, at one point they were 2.5% up. I said that the 112 were looking like they were calling us, and sure enough, boom, closed 112.5, and I didn't think they were going to do it in one day. I said sometime this week they're going to shoot for 112, and they went up to almost 113, broke 113, but close to 112.5. So open interest tells us that there's still some upside, but possible. But I think that we're going to revisit the 1850s at some point, possibly. So that's why I wanted to buy a put spread, but higher than 1850. I want to take advantage of them going through my spread. Am I? Do I still have you guys?
Yeah, yeah.
You're breaking up.
Hello?
You're breaking up a little bit. Joel,
Yeah,
Joel, are you still there?
yeah, I am. Nick, I just want to ask you about some of these momos. We were talking about Yelp, and there was rumors with Google on Friday. Stock got a little bit of a pop yesterday. Just just from a technical standpoint, it's really hard to buy this stock. Is it on your radar at all?
Yes, it is. Yelp. As soon as I heard the rumor on Friday, which incidentally was just after I opened the spread in Google, so I was like, "Uh-oh." I figured it was a good play to use the Google. And what I did with my money, I sold the spread in Google, and I financed some calls in Yelp. And I closed the calls yesterday at the pop. And I rolled them from a May call to a position to a June call position, and I'm just sleeping on those calls. A couple of reasons why. Yelp is it retraced quite a bit, so I'm thinking, okay, it might still retrace from here, but there's likelihood that there might be more upside just all by itself without the rumor. And if you tack on another rumor, but although about that rumor, it usually it doesn't linger for 3 days without anybody mentioning it. So it might be just that, a rumor. But I'm still benefiting. I mean, it had a good day yesterday. It's looking like it's having another day today. Pre-open, it was up in the 57s. I'm not sure if those are going to hold up or not, but I'm in it. It's a lotto position. By lotto, I mean it's a small cost to me with a decent payout potential, just like a lotto ticket. And I'll just sit on it. It's a June position. It's a few $100s. I'm not going to cry over it if I lose it, but it might pay off.
Okay.
When you're getting into your lotto trades there, Nick, or how do you find those ideas? Are you just scanning through stocks and then just looking at the premiums, outside premiums, and finding them cheap, or how you take us through one of those trades, how you find that trade first of all, and then how you execute it?
Lottos, most of them I do them around earnings. So
Okay.
I look at the open interest in the earnings, and I go with the herd.
Okay.
I don't go against the herd. A few situations I do. I think it was Yelp. I messaged you about it. I saw 6,000 or 7,000 puts at the $60 level. Or $70 level just before the earnings, and they were all puts, and I thought to myself, whoa, somebody made a lot of money in that position, and I thought that market makers might push it up there, and the next day they pushed it to 66. They flushed them all down to $4 profit, probably over wherever it was from, 50 or something. So sometimes things like that happen, and most of the clues I take are from the options position, and I don't assume I'm smarter. I know you said you go against the herd. I sometimes do, but I don't make it a habit.
Okay.
Yeah, I make it habitual, but sometimes works, sometimes doesn't.
Well,
sometimes you get run over by the herd.
we have to talk about the Apple, right? Because
you're reading my mind here. I was just because I don't know if you listened to the show the other days. We sure hope you do, but I kept on saying, boy, Nick was right about that 600 call open interest. Nick, and
you saved me some money on that.
Yeah, Nick.
Yeah, I sold it just because Nick said he didn't like it. He thought it was going to go back below 600. I sold my call there. My calls 602 or whatever when the stock was up there, and it tanked 10 points that day. So thank you, Nick. That was a great call.
You're welcome. I was just reading the tea leaves. No Nostradamus moves there. And the tea leaves keep telling me that the 600 level is a challenge for Apple, especially now that the catalyst has come and gone. We need that proverbial flying car from Apple to break through. Yesterday, today it's threatening again, but the options are saying otherwise. 600 is a toughie, but the battle zone moved up a little bit, so it's going to help the bulls a little bit. So now the 595, which was a little strong, 590, 595 was a good strong band of resistance yesterday. Today, not as much. 590 is neutral. 595 is still a little bit of resistance, but really the 597.5 is nothing much. So 600. So if they break 595, they can slide into 600, but they're going to run into a wall.
So you think that just like technically, there's really nothing the stock can show you technically to get rid of that $600 level? You think that after earnings that the drivers are gone and that it's going to take really like a new product or a new innovation or something, just no more financial engineering at this point?
Well, if you look at the chart on Apple,
Okay.
it's 600. 600 is really where it broke down from. Usually, when I'm looking at a chart, I'm not a technical guy, not a super technical, to the dollar guy. I go with the spirit of the emotions. So if you consider that the 700 high poke area was an overshoot. So you take out that whole triangle that went up. That was way back. I'm looking at a 2-year, by the way. Sorry about that. That was around middle of September of 12. That was the high of 700-ish. And if you take out that small triangle from anything above 600 as an overshoot, that whole round trip, you say, okay, that was an area where it wasn't supposed to be. Well, now it's back at that, like the bowl from the 2-year. It's a cup and handle-ish. So technically, okay, it might go up to the 700 and then some, but we still need a reason. It's butting up against the same level. It's building energy from higher lows. So yes, technically it argues for a poke through, but the options market is saying we don't believe it yet. And though technically it might look like it's ready for a breakout, I'm not sure if it's technically a cup and handle, more maybe like a rounding bottom that looks like a cup and handle, but it is building energy. When it's going to break out, I don't know, but it's not in May when you look at the options market. They're saying we're waiting a little bit, but it is building energy.
Okay.
So the next catalyst will probably be obviously the split, but then they'll probably end up putting it into the Dow or something, and then that'll be the next catalyst to drive it higher if they do that. But
yeah, well, that's been the ultimate catalyst of late. People saying we're splitting, we're adding dividends, and we're going to increase the buyback, the trifecta. That almost killed me in Mastercard one time. I was shorted when they did theirs. I barely got out without being a disaster. But that's what in vogue these days.
And let's just talk a couple of the other momos here. Twitter seem to have come off a bottom. Barron's talked about it over the weekend, kind of getting a floor in there because of getting down to the levels it reached. It might have some potential takeout value. Were you able to play that one at all after that slide under $30?
You know what? I had an order open for the 29 puts for pennies, and I was so greedy. I wasn't increasing my limit to buy the puts when it was still in the 30s after the initial drop. I'm kicking myself because those went up to dollars for a little bit at the extreme low, and I would have cashed them in, but I didn't get that order. So I tried, I couldn't. It's worth a flyer. They're gonna figure it out. As much use they get, they're gonna figure it out. So it's worth a flyer, maybe even leaps. Buy it and forget it, and see what happens. And meanwhile, maybe you can sell some calls against the calls you buy out in time, kind of a calendar play of sorts. But yeah, it's worth a flyer. I mean, it's hard, like I say about Facebook, it's really hard. It takes a special kind of idiot move to mess up 1 billion users. Same with Apple. And it's same with Twitter. I mean, this much use, it's really hard to not figure it out. And if they don't figure it out, somebody else will and buy them out.
Ah, that's a good point. Okay, so just finishing up here on the market, we did make a pre-market high, 1896.75. we've fallen back a little bit from this, putting significance on the former old-time, well, it is still the old-time closing high at 1992.75 was the close. We hit 92 and a quarter in the pre-market. So just early in the session here, if you don't get that follow through to 1900, off the bat, are you going to take a little bit more of a defensive stance in the market today?
Yeah, I'm going to see how far they're going to take it. The 1900 is not as big of a wall as it has been in the last couple of weeks, but it is a decent size wall, but it's more of a range. Anything above 1900 is all resistance. Resistance. So I'm looking to see how far they're going to take it. It's like a tide. Okay, how far to my toes is it going to come? And I'm going to throw some credit call spreads there. And if I'm not too brave to do it in the May contract, I may go out to June and go out a lot higher into high 19s. And then I'll book that when it retraces a little bit, because the options market tell me that they want to pull it back, but they're not saying we're going to collapse it.
Okay.
But everybody's expecting a pullback of sorts.
Okay, now Nic Chahine on MarketFi, creating income with option spreads. Giving our listeners a lot of different ways to approach stocks and be involved in the market. Nic, as usual, great having you on, and we'll speak to you next week.
Thanks, guys. I appreciate the invite every time.
Okay.
Thanks,
all right.
Nic.
Nic Chahine.